Welcome back, CA students, to part 7 of our Explainer series. आज हम एकदम in-depth conceptual clarity के साथ The Companies Act 2013 का Chapter 6 कवर करने वाले हैं. अगर आपको याद हो, in Part 6, we wrapped up our discussion on foreign, government and Section 8 companies. तो आज, picking up right from there, we are cracking the exact ICI requirements for 3 very unique corporate entities: dormant companies, Nidhi companies and public financial institutions.
आज का एजेंडा बहुत ही क्लियर कट और स्ट्रेट फॉरवर्ड है. We are going to do a deep dive into these 3 specialized entities, compare their real world operations, और एंड में मैं आपको एक अल्टीमेट चीट शीट टेबल दूंगी for your quick exam revision. Let's get started. Okay, let's jump right into chapter 6. You know, corporate world में हर company रोज active business नहीं करते. While a normal, everyday company is constantly trading, selling, or manufacturing, the Act recognizes that some companies are actually formed for very specialized, sometimes completely passive purposes.
चलिए, सबसे पहले समझते हैं हमारी फर्स्ट स्पेशलाइज्ड एंटिटी को, द डोर्मेंट कंपनी, और इसका इनएक्टिव स्टेटस.
A dormant company essentially operates like a shadow ninja, resting quietly, preserving its chakra for a future mission. It is absolutely not a dead company. It's just inactive by choice, simply waiting for the right time to strike. Exam के लिए ये specific definition mark कर लो. Section 455 clearly states that these companies are formed just for a future project or to hold an asset or intellectual property without making any significant accounting transactions. Practical situation समझो. Suppose a tech startup develops a revolutionary new software algorithm. To protect it legally, they form a separate company just to hold that IP. या फिर, imagine you buy a massive plot of land today to build a mega factory 5 years down the line. अभी कोई daily business नहीं हो रहा, right? That is the perfect real-world use case for a dormant company.
Now, apart from registering as dormant right from day one, a regular active company can also slip into this inactive status. So the crucial point to remember is that a company can be classified as inactive if it meets any of these 3 specific conditions over the last 2 financial years. ध्यान देना है, हाँ? It's an or condition. If it hasn't carried out any business operations, or has had no significant accounting transactions, or simply hasn't filed its financials and annual returns for 2 consecutive years, it naturally falls into the inactive bucket.
Now here is a major exam trap. ICI loves testing this specific concept. What exactly wakes up our sleeping ninja? I mean, what counts as a significant accounting transaction? अगर आपकी कंपनी डोमेंट है, आपको लीगली एग्जिस्ट करने के लिए कुछ बेसिक पेमेंट्स तो करनी ही पड़ेंगी, राइट? Paying mandatory fees to the registrar, fulfilling basic legal requirements, allotting shares, or paying for basic office and records maintenance. These are legally excluded. Paying these does not break your dormant status, so don't get tricked in the exam. However, anything like buying inventory, trading goods, or selling a service, basically any core business transaction, is a significant transaction that immediately revokes your dormant status.
Now, let's switch gears and move to Section 4061 to see how a Nidhi company functions. Unlike the purely passive dormant company we just saw, a Nidhi operates completely differently. Nidhi basically translates to a mutual benefit society, और इनका sole operational focus strictly अपने member community के अंदर savings और thrift की habit को cultivate करना होता है. ये general public के साथ बिल्कुल deal नहीं करते. Think of them like a localized shinobi clan. Practical example. Imagine a close-knit community of local artisans. Standard bank loans might be really tough for them to secure, so they come together and form a Nidhi company. All the artisans deposit small monthly savings into it, cultivating thrift, and when one artisan needs a loan to buy new tools or raw materials, the Nidhi company lends specifically to them at a reasonable rate. It is strictly by the members, for the members. Keep in mind, this special Nidhi status isn't something that happens automatically. आपने बस दोस्तों के साथ कंपनी बनाई और म्यूचुअल बेनिफिट शुरू कर दिया, ऐसा बिल्कुल नहीं होता. The central government must officially declare the entity as a Nidhi by publishing a notification in the official gazette. This strict layer of regulation ensures that bad actors don't misuse the mutual benefit tag to run unregulated, risky shadow banking schemes. अब आते हैं हमारी इकोनॉमी के heavyweights पर, Section 272, which defines our public financial institutions or PFIs. अगर डोरमेंट कंपनी एक शैडो निंजा है और निधि एक लोकल क्लान है, तो PFI is basically the supreme kage of the financial village. They handle immense power and unbelievable amounts of capital.
ICI loves asking for examples to test your practical awareness. तो ध्यान रखना कि real world giants like the Life Insurance Corporation of India (LIC) and the Infrastructure Development Finance Company (IDFC) are explicitly named as PFIs under the Act. These institutions gather massive public wealth and channel it directly into building the nation's core infrastructure. Think huge highways, massive power plants, and nationwide telecom networks.
So, what exactly elevates an institution to a PFI? The golden number here is 51. An institution can only be notified as a PFI if not less than 51% of its paid-up share capital is held or directly controlled by the central government, state governments, or a mix of both. Plus, they must be established under a specific central or state act. This strict 51% rule guarantees that these absolute economic giants always operate under the ultimate control, direction, and safety net of the government.
Fantastic. अब इन तीनों यूनिक कॉन्सेप्ट्स को एक साथ कॉन्ट्रास्ट करते हैं, so you can lock this into your memory. रियल वर्ल्ड में देखो तो इन तीनों का ऑपरेशनल फुटप्रिंट एकदम अलग है. A dormant company is purely passive. It's an empty vessel securely holding assets, IP, or preparing quietly for future projects. Nidhi is highly community-focused. It operates like a localized savings club in a completely closed loop of its own members. And then you have PFIs, which are entirely macro-focused, deploying massive public funds for national-level financing under strict government control.
Take a quick screenshot of this right now. This is your ultimate exam revision table mapping the exact entity types directly to their section numbers, core purposes, and key conditions. Dormant is Section 455, requiring no significant accounting transactions. Nidhi is Section 4061, mutual benefit that must be officially declared by the CG. And PFI is Section 272, requiring that absolutely crucial 51% government capital. Reviewing this quick cheat sheet right before walking into your exam hall will save you so much time and keep your concepts crystal clear. To wrap up this explainer, let's test your conceptual clarity. We know that paying routine office maintenance doesn't break dormant status. But think about this for your next case study question. What happens if a dormant company suddenly receives a massive, completely unexplained foreign dividend? Does our shadow ninja get exposed immediately? Or is it another exception? Apply the rules we just discussed, keep studying hard, and I'll catch you guys in Part 8.